I once watched thousands of dollars evaporate on a stock I knew was failing, simply because I was too embarrassed to admit I was wrong. Most new investors don't lose money because they're bad at research. They lose because they're being silently sabotaged by 5 invisible psychological traps. Right now, one of these traps is actually costing you money, even if you haven't bought a single stock yet. In this video, I'm exposing the exact mistakes people are too ashamed to talk about, including the 2 that almost wiped me out. I will give you the specific fix for every single trap, so you can stop guessing and finally start making the money you actually deserve. Let's dive into trap number 1. The first trap feels so logical, it's actually dangerous. It's the average down forever trap. You buy a stock at $100. A month later, it's at $80. You think, great, it's on sale. You buy more, bringing your average cost to $90. Then it plummets to $60. You think, what a bargain, and double down again. You think you're being a savvy buyer while others are panicking. But here's the cold truth. You aren't investing, you're just trying to prove yourself right. This is the sunk cost fallacy. You're throwing good money after bad because admitting you were wrong feels like a gut punch. You're confusing this with dollar cost averaging, but DCA or SIP is for broad markets, not for a stock that's circling the drain. You're trying to catch a falling knife and you're going to get cut. To beat this, use a 2-part rule. First, the fresh money test. Ask yourself, if I didn't own this stock, would I put my hard-earned cash into it today at this price? If the answer isn't a 100% yes, you don't buy more, you sell. Second, set a hard stop before you ever hit the buy button. Decide that if the stock drops 15% and your original thesis is dead, you're out. No emotions, no what-ifs, no hesitation. Because if you don't learn to cut your losses, you'll end up with a portfolio that looks more like a graveyard, which leads us directly to trap number 2. Be honest, is your portfolio an engine for growth or a museum for dead ideas? Are you holding on to losing stocks like they're ancient artifacts because you refuse to let go? If so, you're suffering from loss aversion. Psychologists have actually proven that the pain of losing $100 is twice as powerful as the joy of gaining $100. This one glitch in your brain is what turns a high-performance portfolio into a graveyard of dead money. You stay anchored to the price you paid, hoping it'll come back just so you don't have to admit the loss is real. But remember, hope is not an investment strategy. Every day you hold a loser, you're essentially buying it again at that price, instead of putting that money into a winner. To fix this, you need to become a ruthless curator. Every 90 days, perform a portfolio purge. Look at every single stock and ask 2 questions. Is the original reason I bought this still true? If I had the cash today, would I buy this exact stock right now? If the answer to either is no, you sell immediately. Your goal isn't to be right about the past, it's to be profitable in the future. Free your capital from hostage. Now, this fear of admitting a loss is powerful, but for some, that fear is so overwhelming it leads to an even quieter trap, one where you lose money without ever even buying a stock. We cover that next. If these fixes are giving you a clearer path forward, hit that like button. It helps the algorithm share these with other investors who are stuck in these same traps. Also subscribe to get wired for money. The third trap is a silent thief. Most new investors don't even realize they're being robbed until it's too late. It's the cash drag blind spot. This is for the person who's been too careful. You've avoided the first 2 traps, but now 40% or 50% of your money is sitting idle in a savings account. You're waiting for the perfect time, that one big market crash that will make you rich. But here's the reality. While you're waiting for a crash that might not come for years, the silent thief of inflation is eating your future. If you're earning 1% interest while inflation is at 3%, you aren't being safe. You are guaranteeing a 2% loss every single year. By being too afraid to lose money in the market, you're making it a certainty that you lose money in the bank. Doing nothing is the most expensive decision you can make. To break the paralysis, use the core and explore strategy. Take 80% to 90% of your capital, your core, and put it into simple, low-cost index funds. Automate it so you never have to decide to invest again. This ensures your wealth is always building in the background. The remaining 10% is your explore fund. This is your play money. Use it to speculate on individual stocks or high-growth ideas. This scratches your itch to be active without putting your entire financial future at risk of your own impulses. But once you start managing that explore portfolio, you have to know how to handle a win. Doing the opposite of what I'm about to tell you is exactly how most beginners kill their own momentum. That's trap number 4. The fourth trap is a perfect reversal of what every successful investor does. It's called the disposition effect, but I call it the I need to feel a win mistake. It works like this. You buy 2 stocks. Stock A goes up 30%, so you quickly sell to lock in a profit. It feels amazing. Meanwhile, stock B is down 40%, but you hold on with a death grip, praying for a comeback. In other words, you are watering your weeds and cutting your flowers. This isn't just a bad habit, it's a documented wealth killer. A massive study of 10,000 investors found that the winning stocks people sold actually went on to beat the losers they kept by over 3% in the following year. We are hardwired to crave the tiny dopamine hit of a win and avoid the sting of a loss. But the market doesn't care about your feelings. It only cares about math. The pro rule is simple. Cut your losers fast and let your winners run. For your winners, stop selling just because you're up. Instead, use a trailing stop, an automatic order that only sells if the stock drops a certain percentage from its peak. This locks in your gains while giving your best ideas room to explode. For your losers, ask the question from trap number 1, is my reason for buying still true? If not, sell it. Take the tax loss and move that capital into a winner. Remember, your goal isn't a collection of tiny wins, it's a few massive winners that pull the whole train. All these traps require you to make smart moves once you're in the game. But this final trap is the most dangerous of all because it stops you from ever getting started. This trap is the most dangerous because it feels like progress. It's the research substitution trap. This is where you spend hundreds of hours watching every video, listening to every podcast, and building a massive watch list of 100 stocks. You can debate valuation models all day, but your actual portfolio has a grand total of $0 in it. You've fallen for the illusion of competence. Your brain is tricking you into thinking that consuming information is the same as building wealth. It's not. There is a massive difference between being a student of investing and being an investor. One has a playlist, the other has a funded account that's actually growing. Paper trading and learning are great for the basics, but they can't teach you the emotional discipline needed when real money is on the line. The fix is simple, but it requires courage. Take action now. Start small, but start. Put $100 or whatever you can afford to learn with into a simple, broad market ETF. You will learn more in 1 week of having skin in the game than in 100 hours of YouTube videos. Follow my 1-hour rule. If you've spent more than 1 solid hour researching a basic index fund, you're overthinking it. Buy it. Action creates clarity. Those tiny, affordable mistakes you make today, that's not losing. That's the tuition you pay to become a millionaire later. The most successful investors aren't the ones with the most knowledge. They're the ones who consistently avoided the 5 dumbest mistakes we just covered. So there you have it, the 5 quiet traps destroying beginner portfolios. Be honest. Which of these traps have you fallen into or come closest to making? Let me know in the comments. Watch these videos next and let's get your money working for you.